Markets buoyed by a big tech turnaround, but earnings season kicks off next week, and we're getting new inflation numbers. So how long does this last? Satori Fund founder Dan Niles joins me now. Dan, thanks for coming on the show, and congrats on a great first half. The market, of course, got clobbered, but you were up on a gross basis at least. Well done.
Thank you, Jack. Appreciate it.
So you highlight two key factors that's going to put pressure on the economy and the markets in the coming year. The Federal Reserve hiking rates, companies' earnings falling. Tell us about that.
Sure. I mean, my view is really simple. Like you said, don't fight the Fed. Historically, that's been used in a positive way of if the Fed's stimulating the economy, you want to go with it. But it also works in reverse, where the Fed is at the beginning of a tightening cycle. They've only tightened 3 times. They've got a lot more they have to do. You're probably going to get another 50 to 75 basis points at this next meeting. My guess is it's closer to the 75. We get inflation data coming out next week. It'll probably still be pretty high. And that's going to drive multiples down. And the second part, as you mentioned, is earnings. And we're going to start this Q2 earnings season, and you have a lot of really big things that are going wrong. The dollar is up 6-7% since April. You've had commodity supply chain issues pressuring margins, and you've got inventory stacking up, and you've had some very big companies already negatively pre-announce within 3 to 6 weeks of just giving guidance. That includes names like Microsoft, Target, Restoration Hardware. So I think this is going to be a really ugly earnings season coming up.
Okay, so ugly is the key word here. Just how ugly does it get for the markets? What's your prediction on where the S&P finally bottoms?
So we started the year thinking, it's going to be down at least 20% peak to trough. In May, we changed that to thinking it was going to be down 30 to 50% because you've got two things that have happened. One, you've had multiples come down, but they haven't come down as much as they need to given where inflation is. If you want to be incredibly optimistic and say CPI is going to go down from 8.6% down to 3%, with CPI above 3%, the market multiple for the S&P is still 15 times. Today, it's at 19.5. On addition to that, you've got earnings, and those are probably going to have to come down 10 to 20% before this, downturn is over. And that's going to just start in Q2, and I think that's going to continue for several more quarters. So that's how ugly I think it can get.
That is ugly math. Okay, so how should an investor position his or her portfolio given all of this?
Well, I think it depends on what you're able to do. So if you can watch names daily and you can get short names and you don't mind trading around, you can try to use that to make money. But I think for most investors, just sitting in cash and saying, look, I'm going to deal with losing 6 to 7% to inflation, and then I'll buy when we are in the depths of the recession, the Fed has finished tightening, and then put my money to work. I think that makes the most sense for the average investor, unless you can get aggressive short stocks and trade around positions.
Let's talk about a few ideas you have right now, at least places to hide out during tough times. And one of them seems like a scary neighborhood to me: Chinese internet stocks. What's the case there?
Well, I think there are a couple of things. So if you look at the U.S. names in technology, you've got problems that they're dealing with which are economically based. It's costs going up and the dollar going up and demand falling off, et cetera. If you look at China, what you have there is a lot of their issues are self-inflicted. So if you remember, it started with China blocking the Ant Financial IPO for Alibaba way back in 2020, and that's continued with heavy regulation on those companies. In addition to that, you have the Chinese locking down cities. Now what they're doing is they're backing off of some of that regulation, is mostly done. They're starting to reopen some of the cities. They've changed the travel ban from 14 days or quarantine from 14 days to 7 days. And they've actually pulled in infrastructure spending from next year to this year. So the Chinese are stimulating their economy, while in the U.S., we're trying to kill off inflation and tightening. And so those are two very different scenarios. And KWEB is a good way to participate in that. And even if you look at this last month, the KWEB was actually up about 12%, while the S&P and NASDAQ were down 8 to 9% during the month. So it's hung in well, and part of that is it's gone down. It was down 80% from peak to trough at one point, where it had to work through all these earnings issues and multiple compression and all this stuff that we still think is in front of us in the U.S.
Thanks for your insights as always, Dan.
Thank you very much, Jack.